When people think of the India-China rivalry, they imagine tense borders, heated trade disputes, or diplomatic clashes. But a new front has opened up, and it's not about bullets or ballots. It's about batteries. Welcome to the high-stakes battle for dominance in the global electric vehicle industry, a sector that may shape the future of transportation, energy, and technology itself. On one side is China, already a global EV superpower. On the other is India, an emerging manufacturing force with dreams of becoming the world's next industrial hub. Instead of collaborating, these two Asian giants are colliding. India has started putting up walls, tariffs on Chinese steel, barriers for Chinese automakers, demands for technology transfer. At the same time, China is quietly pulling back, drafting rules that could ban its companies from sharing EV technologies with India. Investments are drying up, local projects are being shelved. What looked like a booming future for Chinese EV companies in India is suddenly in retreat. So here's the question: why is China backing out of India's EV industry? And what does that mean for India's dream of becoming a manufacturing powerhouse? Let's break this down. Not long ago, Chinese cars were seen as cheap knockoffs, basic, unreliable, rarely trusted outside their home market. But in less than a decade, that perception has flipped completely. Today, Chinese EVs don't just compete, they dominate. From January to August 2024, China exported 3.21 million vehicles, a jaw-dropping 69% increase compared to the same period in 2023. By year's end, experts predict China will surpass 4 million exports, overtaking Japan and Germany as the world's largest auto exporter. And these aren't bargain bin cars anymore. Brands like BYD, NIO, and XPeng are producing sleek, high-tech EVs that rival Tesla or Volkswagen, often at 30 to 40% lower prices. That price-performance edge is reshaping markets from Latin America to Europe. Take Norway, one of the most EV-friendly countries in the world. There, nearly 1 in 5 new electric cars sold now comes from a Chinese brand. But the real engine behind China's dominance isn't just cars, it's batteries. China controls over 75% of the global EV battery supply chain, from mining and refining critical minerals to producing cells to building entire gigafactories. That's like controlling the oil of the 21st century. In short, China doesn't just build EVs, it builds the ecosystem, the tech, the infrastructure, and the supply chains the rest of the world needs. This is the powerhouse India is up against. For India, the EV revolution is a once-in-a-century chance to leapfrog into the top tier of global manufacturing. With a massive domestic market, a booming tech sector, and government push through programs like Make in India and PLI schemes, the ambition is clear. India wants to be the next great manufacturing hub. But there's a problem. India wants foreign investment, but it doesn't just want money, it wants control. India has made it clear to foreign automakers, if you want to play here, you can't just dump cheap imports. You must set up local factories, share core technology, and commit to Indian ownership and sourcing. This strategy has created opportunities. Tesla has explored entry, Tata and Mahindra are scaling up. But it has also scared off some of the world's biggest EV players, especially from China. For example, India slapped a 30% tariff on Chinese steel, raising costs for Chinese firms. Multiple proposals by Chinese automakers were rejected or stalled, often under the banner of national security. Investments above 15% from Chinese firms require special approval. In short, India is trying to build a fortress, welcoming partners, but only on its own terms. But Beijing sees this very differently. China didn't become the world's EV superpower by accident. It poured billions into research and development, built massive supply chains, and nurtured its automakers until they could outcompete global giants. That technological edge, in batteries, motors, and smart vehicle software, is now its crown jewel. And China has decided it won't hand it over easily. In 2024, Beijing began drafting new rules to ban or strictly control exports of core EV technology, especially to countries like India. We're talking about battery management systems, advanced drive motors, smart software for autonomous driving, and production know-how for gigafactories. Think of it like this. India wants the recipe, not just a slice of the cake. But China is now saying, you can buy the cake, but you don't get the oven. And this wasn't a random decision. It came after a specific case that, well, really set off alarm bells in Beijing. Back in 2017, China's state-owned SAIC Motor took over a defunct GM plant in Gujarat and launched MG Motor India. The plan was bold crack into one of the world's fastest-growing auto markets and eventually use India as an export base. For a while it worked. MG rolled out stylish cars, including one of India's first mass-market EVs. Sales climbed, brand recognition grew, and SAIC even planned a second factory. But then, politics shifted. After border clashes in 2020, India tightened scrutiny on Chinese investment. Public trust in Chinese firms soured. By 2023, things took a dramatic turn. Indian conglomerate JSW Group acquired a 35% stake in MG Motor India. On paper, this looked like a partnership. In reality, it came with strings, local sourcing mandates, governance changes, and increasing pressure to transfer technology. What began as a fully Chinese-owned venture had, in just a few years, turned into a partly Indian-controlled company. To Beijing, this wasn't just business. It was a warning. If Chinese companies invest in India, they risk losing not just market share, but also their technology edge. That case, honestly, reinforced why China needed to lock down its core EV secrets. If India was closing doors, China looked for windows. And it found one, right next door. In 2023, BYD announced a $1 billion investment in Pakistan to build an EV plant expected to be operational by 2026. Other Chinese automakers, Great Wall Motors, Chang'an, even SAIC itself, began exploring or expanding in Pakistan. Why Pakistan? From Beijing's perspective, it's simple. A smaller, less competitive auto market means fewer demands for tech transfer. There are strong political ties through the China-Pakistan economic corridor, and a government more welcoming to Chinese investment. And here's the kicker: vehicles built in Pakistan can still reach Indian consumers indirectly, whether through third countries or as non-Chinese imports on paper. In other words, even as India tries to keep China out, Beijing is setting up shop next door, keeping production costs low, protecting its technology, and still tapping South Asian demand. That's a strategic detour India didn't see coming. All of this, honestly, leaves India in a tough spot. Without Chinese investment, India risks falling behind in the global EV race. Why? Well, there are three reasons. First, infrastructure. China controls battery production. Without access to Chinese supply chains, India must scramble to build its own, and that's a process that takes years. Second, technology transfer. India hoped foreign players like Tesla and BYD would bring advanced know-how. Without China, it becomes more dependent on the West, where companies are slower and more protective of their intellectual property. Third, time. Every delay matters. While India builds, China floods markets with affordable EVs, widening the gap. Yes, India has strong domestic players like Tata and Mahindra, but without the pressure of Chinese competition, they may innovate more slowly, keeping prices high and slowing adoption. The risk is simple. India's dream of becoming a global manufacturing hub could stall before it even takes off. Step back and look at the big picture for a second. India and China aren't just rivals on borders or in trade, they're locked in a battle over the future of technology and industry. The prize? Leadership in the electric vehicle revolution. India wants growth, jobs, and independence. But its strategy of high tariffs, tight control, and selective openness could isolate it from the very advancements it needs. China, meanwhile, is recalibrating. It's not retreating. It's repositioning. By shifting investments to friendlier countries like Pakistan, it protects its tech while still expanding its global reach. Here's the truth. In the 21st century, industrial strength isn't built with walls. It's built with bridges. So the question is, should India open up more to Chinese investment, taking on the risks for the sake of growth? Or is it right to draw a hard line, even if it means falling behind? Drop your thoughts in the comments, because this isn't just about cars. It's about the future of global power, technology, and who gets to lead the next great industrial revolution.